Good afternoon, everyone, and welcome to the September edition of the BizVal webinar. I'm Graham Stephen, the CEO and co-founder of BizVal. Today, I'm joined by my co-founder and regular co-host, the Finance Ghost, as well as our special guest, Sibusiso Umbanambi. He's the founder and MD of Cosworth Capital. So we're always seeking out interesting speakers and topics that can assist entrepreneurs in their business journey, and particularly as so far as it comes to exit planning. Until a few months ago, I'd never heard of a search fund. But today, Sibu is going to share with us exactly what a search fund is, how it works, and how it can assist entrepreneurs in their exit planning journey. We'll get back to that shortly, and I'll introduce Sibu formally just now. So before we get started, just some quick housekeeping. The chat section, as you know, is set to private, so only the presenters and moderators can see your messages. But please feel free to add questions as we go along, and we'll pick this up when we get to the Q&A section of the webinar. As usual, we'll have sort of a 10-15-minute presentation by our guest, and after that, we open the floor to questions. Please also be free to check out the handout section of Demio. You can download our latest newsletter over there. If you guys want copies of the slides, please reach out to Sibu directly after this. We'll reach out to the BizVal team and we can connect you with Sibu directly. So at our previous webinar, we encouraged our users to get our new free and instant express valuation tool. We had a number of people in the webinar who actually did it afterwards. So I think guys were focusing on the webinar and they didn't complete the poll. But the results were pretty much as we expected. The express valuation was very much in line with the expectations, and we'd encourage any business owner to give it a go. The link to that is a QR code. You can either go to our website or the link is in the features section of Demio. So if you look on your bottom left-hand corner, click on that, and if you're a business owner and you want a quick snapshot for free on what your business is worth, you can complete that. This week's poll is about succession. And the poll is quite simple, is do you have a succession plan in place? And this can probably, I guess, apply to you equally if you own your own business or if you're in corporate. The first one is yes, I've got a fully documented plan. No, I don't have a plan. I've got an informal or undocumented plan, or I'm thinking about it. So please take a moment and go and populate that during the webinar. If you missed our last webinar, and that was on the importance of strategic planning with Tony Court-Troop from Rochester, New York. It's available with all our other webinars, both on the website and on our YouTube channels. And before we start, just again, a big thank you to all our existing partners in South Africa, the UK, and the US for their continued support. And if you're interested in joining our partner program, please reach out to us. So on to today's webinar, an introduction to our guest. I'm not going to read all of this, but Sibusiso is the MD and founder of Cosworth Capital. Those of you who know the BizVal team know that we are, car aficionados, especially performance and classic cars. And I guess that's probably what drew us to Sibu in the first place. Although those of you that have watched Ferrari versus Ford, you've got to decide which side of the fence you're going to sit on. I'm clearly in the Ferrari camp, but Sibu's clearly a Cosworth man. So he's going to spend sort of 10 to 15 minutes talking to us about the ins and outs of a search fund, and then we'll go into the Q&A mode. So without any further ado, I'm going to hand over to Sibu to introduce himself and take us through what a search fund is.
Sure. Thank you so much, Graham. Thank you for everyone who's joining the webinar. It's really, really awesome to be a part of you and sharing a topic which I'm really, really passionate about. But I think just to start, what is a search fund before we actually answer it, but what is it actually solving for? And I think it's a couple of things, but one big thing is that there's a succession tsunami or a succession sort of crisis that happens every 20 years, right? And just to share just some statistics, and one key sort of surprising statistic is that half of privately owned businesses will be sold in the next 20 years. It's just a function of life. People get old, people get bored, and they need to retire. But to just kind of quantify that, extrapolating from some of the statistics we see in the US, that that is basically about 3.5 trillion rand will change control over the next 20 years. The backdrop of that is that often sellers and the large proportion of kind of these transactions will happen to sort of the micro, medium size. They have very few options, right? Typically, they don't have, well put out succession plans. Financial buyers want certain things. And there's a couple of issues. And the gentleman that you see in this first page, his name is Irv Grausbeck, is a professor of Stanford. And I guess an MBA came to him some 40 years ago and said, I just finished the MBA. I'm not really keen on going back to corporate. What might I do? And sort of in his wisdom, Irv realized kind of the underlying statistics and said, hey, how about you just go buy an existing business, right? And that's kind of the premise, or I think what the model is predicated on, is that they're great businesses that make up a large proportion of any meaningful sort of well-developed economy. And often there needs to just be a change of hands, right? But how do you go about doing this, right? And so the search fund model basically proposes what might it look like if you took an inexperienced, novice, high performance, quasi-narcissistic guy or gal, or partners of guys or gals, to actually, buy this business outright. And that's effectively what it is, right? It's a young, aspiring entrepreneur who, alongside a syndicate of investors, look to buy out sort of a small to medium-sized business, operate it for kind of the long term, and then exit at some point. And if you look at these three kind of sort of compositions or things that contribute to the model, is it makes for a good project. One is an entrepreneur. Two is a business that's kind of lived out its current sort of growth phase and is looking for new leadership. And probably most importantly is a syndicate of investors that have the pattern recognition and the gray hair and wisdom to help make sort of the project successful. In my case, Cosworth, I raised a fund with approximately 17 investors, both local and international. Most of them are international players. But, these are all kind of serial entrepreneurs, serial executives in their own rights, mid-market investors, and search fund searchers, as we call them, in their own right. Some of the names that I'd call out just in my personal project include the likes of Simon Suzman, who's the chairman at Woolworths, Rob Dower, used to lead Alan Gray, Atang, who now has just moved on to leading Santam's short-term insurance, Kobus Rousseau, Tutu. But the international cohort as well is sort of several family offices, entrepreneurs in their own right. And really the idea is that we're on the lookout to buy one great business outright, and upon which I will then operate and drive the growth. But to answer the question more plainly, what is a search fund? Well, I guess there are four key elements in helping to answer that question. One is to say it's an investment vehicle that a young aspiring entrepreneur like myself is able to raise from a syndicate of investors with the purpose of purchasing one business. It is a quasi sort of private equity model. And so whilst search funds offer many different sort of benefits versus a typical financial buyer, one key element of it is that, it's a jockey meets private equity model, where the change of control and succession is solved for alongside the liquidation event. But as an investment sort of asset class in and of itself, it has actually been the best performing private equity asset class over the past 40 years, achieving an average sort of 30% IRR and a return of investment of 2.4x. And again, I think the key building blocks are a great business, a motivated entrepreneur, and as a conduit, the syndicate of investors that have the pattern recognition and are dedicated and motivated to helping that entrepreneur drive the new growth plan. The third facet is that, it is a jockey model. So you typically are looking for really kind of motivated, smart individuals with a happening bias. As we see the model, it is typically individuals from high performance backgrounds, sort of management consulting, private equity, hedge, corporate finance, you name it. And these profiles also usually have a newly minted MBA from a top international school. And so whilst it's a bit of a pioneering project here in South Africa in terms of the search fund model in and of itself, it's one of kind of the big fads in the top business schools now, where young recent MBAs are opting to search and find and operate a business versus go back to corporate. And then the fourth key element is that as the searcher, I then become the single largest or potentially the single largest shareholder in the business. And the way the model will work, and we can talk a little bit in more detail, but effectively I earn up to approximately 25% common equity stock in that business for finding the business, operating it, and successfully exiting it, right? I don't think a presentation or webinar would be a webinar if we didn't have a slide with chevrons. So I thought I'd add one, maybe for all my sins also as a management consulting, but effectively the process works in 4 key stages. I won't double click too much. The one is to sort of raise the search capital. And so search fund, the word fund might be a bit misleading. It's not really a fund per se, in the sense that, this is a captive pool of money that's looking for several businesses to kind of have a portfolio play. It's a fund in the sense that my investors have provided a small pool of capital that I can then use to originate, vet a deal, do transaction services like diligence, upon which once that deal has been baked, I'm able to then request a higher check for them to invest in it. And so 2 to 6 months is basically spent in raising a search fund. We can speak more into detail, but effectively there's, a huge sort of portfolio of investors, mostly internationally, that invest, also funds of search funds, which are kind of private equity firms that only invest in this asset class, that you as an aspiring sort of searcher are able to tap into. The next phase is the search and acquire the company, and that typically runs for 24 months. So I have this opportunity, or SPAC if you would, to effectively find a business within 24 months, upon which that opportunity is basically pulled away from me. And so there's a time-based thing, but that involves getting in touch with brokers, running a proprietary search where you knock on doors, cold calls, whatever it might be, to actually try and originate the deal, talk to potential sellers. What we see in terms of operations, that entrepreneur and their investor base, obviously alongside existing management that would have been found incumbent in the business, usually operate the business for about 4 to 7 years. But we also see search funds, or at least businesses that were acquired via the search fund model, operate for 15 plus years as well. And then obviously eventually an exit, which takes different flavors. Every investor effectively looks for some liquidation event, but very often the searcher remains and says, okay, the project is over from your investment basis, but I still think there's tons of growth to be made. This is a career for me. I want to carry on. Double clicking a little around how I went about actually raising the fund for South Africa. So the context is most of these investors in the specific asset class, invest in North America, Western Europe, and we see also strong insurgence in Latin America. So trying to punt a South Africa project was really, really tough, right? It's a region that they don't know well. They know it's emerging. They know it's growing. They don't really have context. And so a big part of kind of my fundraise process was really trying to build a case for South Africa. And I'd like to share a little bit about that. But I think kind of this quote by Adrian Gore really does speak to what I think the core thesis is that, there are opportunities and people are distracted in South Africa. But if you look at the raw numbers, the data, the movements, and I mean, even if you look at GDP and our recovery post-COVID, we have an incredibly resilient economy, despite kind of, the discussions that we have in media, right? The first proof point that I wanted to say is that, well, you know what? There are businesses of this size. And so a typical search fund looks to buy, a business within 1 to 3 million EBITDA, let's say 20 to 30 million, 20 to 60 million EBITDA in rands. And there are businesses like that, right? I estimate, just using really conservative sort of bottom up estimates, that there are at least 10,000 businesses. And we all know what entrepreneurs sometimes do as it relates to having 2 books. And so this analysis was done using kind of the SARS database, but if you account for the fact that people are maybe underrepresenting the profits and all those kind of things, this number is potentially a lot larger. So we have a great kind of sort of pool of businesses within exactly the mid-market that fit within the size. I think there's also attractive exit outlook for someone who's actually doing this. And so what you're looking at here are sort of funds under management within private equity. So it's basically the money private equity has to deploy in purchasing businesses. And what we see is that, first of all, more and more money is being invested to purchase businesses. But more importantly, when you look at the black part, is that there's dry powder. And so dry powder is just money that private equity has that they just haven't deployed. So there's an overwhelming amount of private capital that's actually available. And if you look at it as a project 5-6 years, there's a real opportunity to exit because there are buyers out there. And I think there's also kind of a triple BE or transformation narrative to be had that's also going on. And maybe this was just really more a pitch of to say, listen, if you're going to back on a jockey, you probably want to back a black jockey in the context of South Africa. And the data also supports this, right? So what you're looking at here is basically the different levels of BEE. And right at the top, well, the black part is transactions where it was level 1. And so what you see over 2018 to 22 is that, from about 3% of private equity deals being level 1 buyers, you're now seeing that 30% of that, is actually. And so it's an increasingly defining kind of feature of private equity or private deals that, it's also kind of an empowerment play, right? A couple of other slides that also spoke to kind of the candidacy of South Africa in terms of growth rates, but effectively that's how I went about kind of building the case. Now, if it isn't incredibly obvious at this point, Cosworth is a search fund, and so it's there are, I think, close to 500 or 600 acquisitions in this model, and so I raised Cosworth Capital with the intention of buying one great business with the support of several investors, really using the traditional search fund model. What are we looking for? I think there's a strong onus on finding one great business, and we can all debate around, what is a great business, but effectively, search funds fall under the ambit of entrepreneurship through acquisition, right? And there's a strong focus on buying a really, really great business. And there are a couple of markers that are guardrails within at least the search fund world of what makes kind of an ideal search fund asset in terms of industry. We're looking for growth. It's fragmented, which means it's open to sort of acquisitive growth as well. There are barriers to entry. The company in and of itself has to be of a certain size, has to be cash flow positive, recurring. But I think there's also a strong sort of social engineering component to it, right? Which is, it is a succession play, right? So you want to buy a business with, a seller and a management team that are proud of what they've built. They're motivated to sell for the right reasons. But there's a stable enough kind of going concern to build on top of that. The key sectors that I'm particularly looking for are really around ICT, healthcare, education, food value chain, wholesale, and manufacturing. Unlike, let's say, in America or Western Europe, because of the size of their economies, people searching can be really, really specific, right? They can say, I am looking for, I don't know, textile distributors within the South Carolinas. I think South Africa is just too small a market. And so my flavor of a search project kind of takes a more agnostic look in terms of industry. But certainly, what we're looking for are recurring revenues, low capex requirements for growth, and a history of strong profitability and cash flows. Simply put, though, I've kind of tried to synthesize, at least in my view, from my experience, what are the markers of a great business? And I think there are 5 key things from my own personal learnings, but also kind of talking to other searchers all across the globe, is that, 1, great businesses grow. They're also defined by repeat and recurring revenues. They derive customer delight. And I'm sorry if all of these things are incredibly obvious. They keep the same employees. So we see kind of low kind of churn rates of employees. And they've been around for a while, sort of 20 to 40 years, right? Now, I thought I'd share just a couple of lessons learned from my own experience searching. So I've been searching for about 7 to 8 months, having started this February. And I'd like to just, share, put it out there. And again, just to heavily caveat that this is my own personal experience. From the deal flow that I've seen and entrepreneurs that I've interacted with, I think it's fair to say that most South African entrepreneurs are short on South Africa. I think maybe for good reason, but I think there's certainly a tendency of kind of a short-term view, kind of with all the uncertainty that's either happening politically or globally. People kind of take the view that, let me make my dividends, I keep it. Even if there are opportunities to potentially reinvest those dividends to growing, buying more market share, most entrepreneurs opt not to, right? I also think entrepreneurs are not cash hungry, but are value hungry. I think tying into one of the earlier points that I made around just the amount of dry powder and capital that there is there to purchase and or acquire businesses, right? Or invest in businesses. Most entrepreneurs have really, really strong balance sheets, or at least the great businesses that I've seen. And so when they're looking for an acquirer, they're not necessarily looking for this huge cash injection, but they're looking for value in terms of network, in terms of skill sets. And I think that was an interesting defining thing, which I think is good, but also kind of makes it, sometimes tough if it's, it's really difficult to kind of sometimes communicate what your value will be, right? An interesting thing as well is that, most South African entrepreneurs have shoes that their number twos can't fill, right? And and really what I'm speaking to there is that you kind of have the MD, the GM, or the CEO, but the next layer of management is just kind of this huge chasm that whether from a skill set, motivation, aptitude, or whatever you want to call it, is just that it's just off. I mean, if you look at America, we see an incredible amount of management buyouts where kind of the incumbent management are saying, you know what, dear CEO, we'd like to seek funding and we'll buy you out. But we see less of that in South Africa in general terms. And I've been surprised to just kind of see that gap between number one and the number twos. I think as it relates specifically to valuations, a lot of what I've encountered is kind of this paradox between business value and income value, right? And so, when a buyer or potential investor is looking to evaluate your business, they're effectively evaluating your going concern and the ability for that business to generate cash and how predictable that cash will be, right? But I think often what I've seen is that most entrepreneurs are looking at it from the perspective of, I'm making X amount. If I keep my business, I continue making X amount. If I sell my business, I make, potentially less amount. And right. And like that will never actually drive a sale, because fundamentally the perspectives of valuing a business and the net impact in one's personal income are two different things. I think maybe tied also to the first one, most SA entrepreneurs miss the opportunity to create value. And I think here I'm making a more pointed sort of comment as it relates to entrepreneurs really thinking about their exit and what a potential buyer considers. And so I've seen a lot of businesses whereby, this business's revenue could have easily been more annuitized or made more repeat in its nature, but they continue chugging along being more project-based, right? And so the value that your business from a potential buyer for having repeat revenue or consistent kind of revenue retention, that derives a much higher valuation versus a business where the entrepreneur needs just like every year goes to hunt. So there's several missed opportunities as it relates to entrepreneurs really taking advantage of the true levers of what creates value for the business versus, a going concern for the business. And the last point, and maybe this is just me saying hats off, is that, I come from a strategy consulting sort of environment. This past 8 months has been a great opportunity to meet, several different entrepreneurs, business owners, and like they are really the unsung heroes for our country. And I think it's pretty representative of what we might see in other countries as well. I mean, these are the guys and girls that are waking up every morning, creating employment, and I've just been so pleasantly surprised to see kind of, the amount of effort, sweat that small business owners and medium-sized business owners put into supporting families and their employees. So let me just park it there. Those were just a couple of the notes that I wanted to share in explaining the search fund model. But in simple terms, the headline is: an aspiring entrepreneur alongside their investors are looking to buy one business outright and then operate it.
Sibu, thank you so much, and I think we all learned something new today. And before I hand over to the ghost to kind of facilitate the Q&A, I've got one question to ask you, which I'm sure is in a lot of people's minds. So, the search fund model predicates one entrepreneur backed by some people looking to buy a business, and you are one of the first in South Africa. The question is how is that scalable or replicable? So, from an impact point of view, is the idea that we should be looking to create multiple search funds and create this as a legitimate career option for, qualified, bright young things, if you want to call it that. So I'd just like your take on, how you see this becoming a bigger player beyond just, your ecosystem, if you call it that.
Yeah, sure. I mean, I think fundamentally the search fund model by design is not a scale play, right? It's saying, I'm 30 years old. I'm going to put all my eggs in one basket. I'm going to be doing this well into my 40s, which is actually really the beauty of it, right? Like, I speak to a lot of entrepreneurs and they're saying, like, I have people call me and knock on my door saying they'll give me this much, they give me this much, but no one is actually willing to sit in my seat and wake up daily, right? And so that's the core kind of value add. But I think speaking to kind of scalability is what we've seen is that there's an incredible strong insurgence of the search fund model in kind of the more developed markets, which is it's an incredibly how can I put it? Now I'm running out of English, Graham.
Replicable.
Yes, indeed, Chief. Thank you, Chief. In that there is a tsunami, right? These small to medium-sized businesses represent a huge component of the succession issue, right? Also, the talent is also there, right? And I think the way to make it more scalable is one to, obviously create the capital pool that is willing to back young entrepreneurs to do this, which I think there's a much greater proclivity to do that amongst kind of sort of the international investors versus the local investors. You go to an international investor, you say, I'm 20 something, I want to run a business that I have no experience. And they're like, yeah, sure. You go to a South African investor, they're like, yeah, I'm not too sure. Hey, like, you need the experience, you need this, So I think there's certainly something to be done as it relates to better sensitizing investors to backing young jockeys to do this. But certainly I think kind of the ingredients of scalability are there. The numbers are there. And I think the talent is actually there as well.
Fantastic. Ghost, I'm going to hand over to you to facilitate the rest of the discussion. And I'm sure there's lots of questions that have come through, so I'm sure we're not going to run short of content.
Yeah, I've got plenty of my own as well. So, Sibu, thanks for your time today. And I think before we kick off, I think just well done on bringing it home to South Africa, because I think there's not enough of this kind of stuff going on here. And it's good to see international investors being convinced of the prospect here. So I'm glad to hear it. And obviously I have lots of questions on that, but I'm going to start with for me, the elephant in the room, which is I didn't go the management consulting route. I went the corporate finance route, but I too, I'm 35 now. So for me, the journey in entrepreneurship is a few years now. And I guess the question for me is, coming from a strategy consulting background, which is not that different to corporate finance, you're dealing with lots of different clients. You're very motivated to change. Sometimes when you're buying a business, what you need to do is actually just more of the same, for example. So I guess my question to you is just, you'll be buying from an entrepreneur who's probably been doing this for 30 years. And you're going to bring a layer of certainly very high-end business education and understanding around the concepts, which is brilliant. Maybe light on the practical, which is where you'll pick up. But I guess the question is, how are you going to prevent yourself getting bored? And it's a serious question, because when you've been doing strategy consulting in the highest boardrooms in the land, I can tell you that, if you're American investors, the Afrikaans word you'll have to teach them is bliksem, because that's what business will do. It will bliksem you harder than a bomb squad in the second half. It really will. And it'll hurt you in ways that you didn't learn about in your textbook. So that's my elephant in the room question, which I'm sure is on the lips of many, is how do you avoid getting bored in this one business for the next decade?
Right. I don't know, mates. I think, I take a different view, right? I think, micro to medium-sized businesses are incredibly dynamic. It's like, as the entrepreneur, you're HR, you're finance, you're technology, you're also the psychologist. And coming from a background of strategy consulting where everything is solved for, like, I mean, I worked at Bain and we had, we had rooms to sleep and we could order free food and like everything is solved for. Like all we need to do is just kind of engage brain on the problem that we're trying to solve. And my personal experience is that, it's actually quintessentially not boring. It's a lot more dynamic. There are a lot more moving parts, right? With that said, I think there's an intrinsic sort of temptation for a young entrepreneur coming in with kind of, this education or this corporate experience to like completely want to change things, right? Like, oh, let's change this ERP and like, let's do this and let's do that. And I think that's more of an issue where you find young entrepreneurs who are inexperienced, wanted to change too much. And I think one of the things that I love about the search fund model is that it does come with tons of gray hair, right? So if I look at my investor base, I think the average age is 40, right? And so you kind of have the syndicate of investors who are constantly like tapering down, the excitement. I remember one of my investors was remarking that one of his investees, a searcher, came back and, after, the first board meeting had like 60 low-hanging fruits initiatives. And he was like, no, we're only going to do like one or two, if that. I think the most important thing. And so I think the ability and or the experience that coming in at it with experienced sort of investors helps to taper down. But I think, to be honest, I think it's incredibly dynamic. I think it's tough to get bored in a medium-sized business, especially in South Africa.
Yeah, that's good. I think the point there being you have to do all the different jobs, and I think that's right. And obviously the bigger businesses, it's less so, but even in the businesses of the size you're putting forward, it is the case that you'll get your hands dirty across everything. So yeah, I think it is interesting. It's just very different. I think that's something that will be an interesting experience for you. I want to move on to the numbers a bit. So there was an IRR, and I know it's just a median IRR. It's not necessarily your target. And it's linked to a question from Jeremy, which is around the average acquisition price for these businesses that you might be willing to pay. I mean, in the private equity deals I've done, so typically the South African private equity houses will say, if they can get an ungeared return of around 20% and then gear it up to say 25-ish, that's kind of a nice place to play. And these IRRs are a bit bigger. Are you using debt in any of these acquisition structures? Are you looking to bring in debt alongside your equity check and then drive your IRRs like that? Or are you targeting pure equity IRRs in the upper 20s? In which case, the final part of the question is, I would imagine the EBITDA multiples are going to have to be relatively light. You'll have to convince a seller on to make those IRRs happen. So maybe just a little bit around how you think about that.
Yeah, sure. So I'm going to share benchmarks, and I'm just going to share that these are mostly US and West Europe benchmarks, but the average sort of price or enterprise value that a search fund buys into is a business doing $10 million, and let's just say that's what 180 to 200 million rand. So that's the average sort of enterprise value, and often that's correlated to a business doing about, like I said, I'd say 20 to 60 million EBITDA, right? In order to earn my full 25% odds, I have to effectively achieve a 35% IRR. So the returns kind of pressure are a lot higher than even for financial kind of private equity buyer who's probably looking for 18 to 25, like you shared, right? And in order to do that, a couple of things need to be right. But certainly one, a search fund would typically buy at a lower price, right? Particularly for that reason. And so a lot of what I'm on the hook for is to drive a good valuation for the business, but also to effectively communicate how my value proposition is different to, say, a strategic buyer or a financial buyer, which is the following: is like, dear seller, this is not just a liquidation event, but this is a change of control. I, as the entrepreneur, will be protecting your legacy alongside your existing kind of team. I'm not firing anyone. I'm not changing anything, but alongside them, I'm developing a new sort of growth plan. And we see even in different searches that, that value proposition does kind of pull the heartstrings of certain sellers, and typically sellers that really care about the going concern and the legacy of their business versus just selling to whoever the higher bidder. So one key element is certainly buying at the right price. And, just to share statistics, a search fund would typically buy at an average 5x. That's kind of US stats, 5x on EBITDA. So you take your EBITDA, multiply by 5, and that will effectively determine what the value of the business is, right? I think there's a lot more downward pressure on that multiple for a search fund in South Africa. The cost of debt is different, the risk profile is different, et cetera, currency and all those type of things. And I think buying kind of closer to the vicinity of 4x probably makes a lot more sense for a search fund in a South African context. But for all intents and purposes, surprisingly, I've come to learn that kind of arena of multiple in terms of valuation, the 4x, is actually not far off from the average. And so that's one of the more interesting things that I'm yet to really realize, is that actually a search fund in South Africa is an incredibly more beneficial value proposition, right? Like, we have better payment terms, we pay a lot of cash up front, and our valuations on average are not too far from, say, what a private equity firm or strategic buyer would offer you in any cases, what I'm seeing here. A second key element of driving growth, you're right, is gearing. So a search fund on average looks to gear anywhere between 50 to 60% of the enterprise value, or let me put it in simple terms, around 3 times EBITDA, right? So whatever your EBITDA is, we probably look to put around 3%. And often one of the key sort of instruments that we use in doing that is what we call a seller's note, right? Or a vendor's note, right? So not necessarily seeking that debt and or delayed payment, depending how you want to think about it, from a bank, but rather seeking it from the actual seller themselves, is a typical kind of instrument. Third, there's an incredible focus on growth, right? Like, we're not pulling dividends during the whole period. We're not looking to drive those returns from paying dividends as early as possible back to the investors. What we're saying is that these dividends are going towards driving the new growth plan, right? And so there's an incredible focus around really growing the business, right? Which is a very, very deliberate. So a search fund is actually long on South Africa versus short on South Africa, which is, I think, the more typical kind of landscape I've seen to date. And what does that look like? It looks like building out a sales team. It looks like installing sort of systems or technologies that allow for scalability and leveraging your employees better. Often it also looks like acquisitions, right? And then the fourth thing is really around, it's a lot easier quadrupling or tripling a business if you're buying from a small base, right? And so we're not buying 200 million EBITDA businesses. We're buying businesses that are doing about 20 EBITDA, and that's I don't want to say easier, but I think there's a lot more bandwidth at potentially driving the type of IRRs that we seek to achieve.
Sibu, maybe I can jump in one last thing on that, and there's lots of questions in the call, but I think some of this is important. So just understanding the way you are incentivized by it. So if you hit that IRR, you earn your maximum. Is it sort of staggered up until that point? And I'll ask you why. As a business owner, if I was giving you a seller's note and I'm exposed to the business still making the money, if you were incentivized to go for broke, get rich or die trying, I'll age myself now with a 50 Cent album reference, and you've got to go for 37.5 or quits. As the seller, I'm exposed to the quits from the sounds of it. I mean, there's no guarantee if the business collapses in the next sort of 2 to 3 years that I would then get paid there. So just in terms of understanding how you address that risk for the seller, And then I think there's quite a few questions we can start to jump through in the Q&A.
Sure. Yeah, let me try and be quick. So I earn up to 25% in 3 tranches. The first 8.3 is on close of the deal. That incentivizes me to actually close the deal, right? So, I'm actively searching and originating. I'm not just spending my investors' money saying I'm looking for business. The next tranche, which is another 8.3, is based on time. So I have to be operating the business for at least 4 years. And that, that's kind of a forward cascade. And then the last tranche is a performance-based, which is basically a spread between a 25 to a 35% IRR net investor return, right? So I have to at least achieve 35% IRR in order to fully vest. With that said, my common stock has no value up until I've paid back my investors, right? So my investors will basically invest with a liquidation pref with some preferred required return. So I could have 100% of the value, but it attracts no economic value, right? So I am deeply invested in making sure that, we drive returns. So just to kind of play that back in terms of numbers, if I buy a business for 100 Rand, I need to give back my investors the 100 Rand plus, let's say, a 10 Rand, let's say 10% was their required return, before my common stock has actually any economic value. I think also it's to kind of reposition and really kind of go to the core of why we use seller's notes. And again, I'm not saying every deal has a seller's note, but it's really around asymmetry of risk, right? I think sellers need to, at some level, appreciate that there's a strong asymmetry of risk between someone who's operated the business for 30, 40 years and someone who's coming in, no matter how experienced or intelligent they are, right? They're effectively assuming more risk. And I think it really is just a mechanism to help share that risk versus kind of a punitive warranty or escrow type mindset to it, right? And again, as we shared, it helps also achieve certain rates of return for the investors. So it's a lovely kind of I'm talking about the seller's notes. It's a lovely kind of instrument that shares the risk, provides returns, but also allows for us to arrive at the right price, or a price where there's a willing buyer and a willing seller.
Sibu, thanks for that. And I think, as Ghost said, we've got a ton of questions, sure. And I know our time's limited. So what I'm going to suggest, you're probably going to pick, sort of 3 or 4 of the sort of, more interesting questions that have come through. Sure. And to everybody who's asked questions that we don't answer, we'll take those offline and contact you directly to answer those. And I'm sure Sibu won't mind, replying by email to one or two of the ones that we don't get to. So if we didn't cover your question, it's not because we're trying to ignore you, it's just to manage time. But I think, maybe if I can jump in with, one of the questions that came through is, how did, part of this model and scaling it and as a career alternative to many bright young things, let's call it that, means that you've got to have lots of search funds at a macro level. But how did you go about approaching investors to get their buy-in? So if this is not going to just be you, but it's going to be another 100 or 1,000 or whatever, how do you go about approaching investors, and what are some of the learnings in that?
Right. So, I mean, one of the good things about the search fund model is that it's very vanilla in terms of the terms, in terms of, it's very constrained. And what it does for an investor is that it allows for the discussion to really be around, is this a jockey that I'm willing to bet on, and or is this a geography that I'm willing to bet on, right? So and so those were essentially the 2 key kind of proof points for the typical search fund investor. I had another profile of investor, which was South African investors, right, who had to not only kind of have me share the proof points of those 2 things, but alongside that, share the proof point of the model, which is effectively giving money to a young guy or gal or team of guy or gals to buy a business in an industry that they know nothing of, right? But the process is effectively simple, right? I think it was to kind of share my candidacy, and I think what they're looking for is skin in the game, right? Like someone who's got a really high opportunity cost, and I guess in my case is I come from a top tier consulting. I have an MBA from the 3rd ranked MBA school. I could be in private equity anywhere in the world, but what I want to be is potentially, running a small, little business alongside a team of people, right? And so what they're effectively looking for is how much does someone really, really want this, right? Coupled with that is a couple of other things like an action bias, a level of intellect, and just sweat, right? And so that was one key sort of proof point that I had to share. The second was really around the candidacy of South Africa as an opportunity for investing, right? And I think I touched on that just a little bit in terms of, the major guardrails of what make for a great search fund project are also true in South Africa. But I think where the rubber really hit the road is really kind of communicating to them what I think the core value proposition of South Africa is, which is we have an over-endowment of highly skilled sort of top tier talent, that can offer services to the international market, export market, if you would, at a fraction of the cost. Coupled with that is we are the growth arena of kind of, globally, right? Like the next growth horizon is coming from that. And then for the local investors, I effectively had to convince them of the model, right? Like, hey, I'm a young guy, and I wanna do that, and that was a lot more kind of tough. But I think what was really supportive was that there's an incredible amount of precedence in the model. Like, that 28.7 IRR average is kind of a 40, 50-year average of search funds all across kind of the world. I think that was one great thing to say, like, hey, this is not a castle in the sky, but this is something, people are doing consistently, kind of all the time, right? But I think one thing that really sort of pulled their heartstrings was, at least some of the things that my investors called out, was that, we invest a lot, but what we don't see is young people opting to leave kind of their high flying sort of careers and saying, I want to be the jockey, I'm responsible, I'm taking ownership over this project. And I think that was kind of just the slam dunk in sharing that. In terms of the how, I don't want to double click too much on that. There's an incredible amount of information on how to set up a search fund. Stanford tracks that well, AUC Business School tracks it well. There's searchfunder.com, an overwhelming amount of information around how to access investors, how to draw up presentations or PPM, the different search fund structures. But I thought I'd kind of just answer your question more in the high level, which is there are three major proof points, and kind of my experience in overlaying that with my investor base.
Sibu, I'm going to ask about just follow-on capital. So, my understanding of the search fund is you kind of make one investment to generate those sort of IRRs. It's quite likely that at some point you're going to need to potentially reinvest in the business, and obviously some of that will come from internal cash flows. Some of it might not. Do you have the ability to do follow-on investing from your current investors as the search fund? Would you potentially, in that case, look to bring, another investor on board? Like, just how do you think about that need for capital on an ongoing basis?
Yeah, sure. So, I was looking at a business, I think on Monday, and the entrepreneur paid himself 130 million rand in divvies, right? So you ask yourself, what are South African businesses really cash hungry? I don't think so. I think I've seen a lot of phenomenal businesses that generate a lot of cash, and that cash can be, really kind of exploited to drive growth. Let me answer it though from the lens of a search fund investor. A search fund investor is effectively looking to back one jockey or set of jockey and one business, right? And so they usually take that view and are not actually keen on follow-up capitalization as it relates to, this business needs more money to buy another thing. And so what we seek to do is, I guess, over the first 3 years, pay down the debt. And then over the next kind of 3 to 4 years following that, really leverage those dividends in driving the growth play, which is alongside existing cash flows, but also to attract, maybe more debt from financiers to help drive that growth. So simply put, investors are not keen on average on putting more, but it also depends on the project, right? So, I mean, there's a project now in the UK looking at managed service providers. It's an industry that is defined by sort of recurring annuitized revenues, and there's a whole bunch of them, right? So and they're like small. So in that case, that is a consolidation play project where the searchers align with the investors from kind of the PPM level when they're still pitching. Is like, what I want to do is I want to buy 10 MSPs over 5 years, and this is why I think I'm well poised to kind of do that. That's a different kind of project where an investor from the get-go knows that this guy's going to ask me for a check of 1 million, and in 2 years maybe another 2 million, and so forth. But typically they want to make one big bet on a jockey and one big bet on that business.
I guess one question I still want to get through before we run out of time, and I'm kind of skimming through all the questions. Sometimes they haven't been asked in exactly that wording, but I think you've talked to a lot of the points that kind of answer that question. But the one that I think keeps coming through is just track record in terms of experience with investments themselves, not necessarily on the strategy consulting side, but actual, just investments completed or involved in, or exits. I guess just a little bit around sort of what you've seen and been involved in, that gives you a bit of a track record to bring to this thing, that you've then layered on what I would imagine was a flipping incredible MBA experience. I think it's what a lot of people dream of, is to go and be able to do something like that in the US. It's incredible. So just marrying that to like some real world investing experience.
Yeah. The answer is none, right? And I think the answer is the same for all searchers. And the reason for that is that I'm not in it to be a transactor. I'm in it to be an operator. I could have easily joined private equity, easily joined hedge, corporate finance, or whatever, if really what energized me was just looking at many different transactions. I want to be in the trenches, right? And so what you'll find is that myself alongside other searchers is that we're not transactors, and certainly that's not our value proposition. Our value proposition is that we're going to wake up every single day and help drive the new growth plan alongside existing management, right? But to answer your question more pointedly, in my experience over the 8 months, it's been a steep learning curve, having to really sensitize me around, the data that's out there in terms of what transaction looks like, what sizes, where the center of gravity looks like in terms of structuring and all those things, cost of debt, proclivities of different investors and all these different things. And, not to be a reductionist to all our amazing transactors and investment kind of fraternity, but it is to say that, with a concentrated effort, as a relatively inexperienced transactor, you're able to kind of, get up to speed on what good looks like on a transaction really, really quickly, right? But my focus is fundamentally on the core fundamentals of the business. I will buy a business in textiles if the fundamentals of that business is great. I'm not in it to, punt, the industry and like, I just want to ride it, a tailwind of global trends or tailwinds or whatever it might be. I'm really in it to be the operator of a business, right? And I think that's pretty analogous to what other searchers at least should be in it for.
Sibu, and I think I think we've obviously covered quite a lot today, and we've got a ton more questions, which, as I said, we'll get back to over email, and we will respond to each of those. But I think certainly the concept of a search fund, I guess it's new to a lot of us, and I think you've really given us deep insight into the concept. It's clearly something that has had a lot of legs and merit in other parts of the world. And I think as I say, the big challenge is, I guess, drawing that. I wouldn't even say the disconnect, but I mean, SMEs being the engine room of growth. Okay, you're getting to the end of a cycle where succession is becoming an issue. Okay, and I guess what I'm hearing you say is there are young, emerging, smart guys who want to get their hands dirty. They're not content any longer just to sit in the boardroom. Okay, right. And perhaps that sounds naive to a lot of people in the room, but I think it's a different perspective, and I think it's incredibly interesting to listen to that perspective and to share that, and hopefully you can find that one investment you're looking for, but hopefully there's also opportunities for others to kind of follow in those paths. So thank you so much for joining us. I'm going to give you a chance now just to close off, and I've certainly enjoyed it, and hopefully based on the questions, it's sparked a lot of intrigue and curiosity. So yeah, I'll let you maybe just say a few closing words, and then we'll wrap up.
Yeah, I think you hit it right. The what is the saying? The hammer on the nail, right? On the head of the nail. But there's a hammer, there's a nail in that statement. Fine. Even within my own circle of friends or networks, there's an overwhelming kind of cohort of guys with similar experiences who really want to get into the thick of it. But there's also a strong recognition that money is required, but even more importantly, a seller who's willing to pass on the baton, is required. And I think those are the two kind of key ingredients that I think we're still short of. I want to just say thank you for this opportunity. I love talking about all things entrepreneurship through acquisition. And to the extent that we weren't able to touch on certain questions or topics, I'm super excited to answer any of those, whether you reach me via BizVal or directly. I'm always happy to chat or hopefully grab a coffee if you're in Johannesburg.
Great. And yeah, thanks to everyone who's joined us today. I hope you found today's topic interesting and valuable. As before, if you've got any specific topics that you'd like for us to cover in the future webinars, please let us know. And just a reminder that our webinars are available on YouTube and our website. So, if you enjoyed today's session, please share it with your friends and colleagues. And thank you for joining us. Ghost, any other closing words?
No, just wishing you the best, Sibu. I mean, it's I specifically asked you a bunch of tough questions, so I think it's important to get through that stuff. But yeah, good luck. I mean, look, as someone who's passionate about small businesses and seeing this kind of stuff, to see international investors backing you to come back into South Africa and find something like this and do this is great. So I really do absolutely wish you the best. And there was a lot of interest in the Q&A, ranging from how do you structure a search fund through to how do I get my name on the list to look at a search fund as a business owner. So there's a hunger for this stuff. And yeah, I wish you very much of the best.
Thank you. Stay well.
Thank you, everyone. Have a great day.
Cheers.
Bye-bye.